Committee will be back in session. I'm going to recognize myself for 5 minutes. Ms. Williams, thank you for presenting this very helpful report by GAO on leverage. I'm interested in GAO's observations with respect to leverage and international efforts such as Basel II to better supervise financial firms. As Congress finishes up writing financial regulatory reform, what steps should we take to coordinate our efforts with other countries to do two things? First, to better monitor and even understand leverage and risk-taking, and second, better constrain excessive leverage.
I think any efforts that we take in the United States, we have to make sure they have a strong international component. I think the crisis made it very clear that what the national focus also had a huge global effort. So in terms of Basel II, I think the U.S. has to continue to be very involved in that process and making sure that we do a true look back at Basel II to determine if we need to go back and have a fundamental reassessment of the current approach to determining regulatory capital. There have been efforts in the past several months to deal with certain issues such as the pro-cyclical nature of capital and making sure that institutions are building up capital levels during the good times so they aren't forced to do that in the midst of a crisis. But there are a number of other efforts that we need to continue to focus on from a global perspective, and Basel II is one place definitely to take a look.
Thank you. Professor Acharya, one thing that was troubling for our committee and Americans to learn at our recent hearing on the failure of Lehman Brothers was how they used Repo 105 and other means to hide their excessive leverage. How concerned are you about debt masking, especially since the SEC depends on quarter-end reporting requirements? Is there a better way to monitor debt and leverage?
I think this ought to be one of the most significant concerns, especially if we are talking about regulating leverage. Not just the use of Repo 105 by Lehman Brothers, but especially from 2004 until middle of 2007, there was over $1 trillion of assets that were parked in off-balance sheet entities, which had direct connections back to bank balance sheets, but that were never consolidated, either for accounting purposes or for purposes of calculating regulatory capital. So one of the big messages, I think, from this crisis is that it's not just important to put in place a law with the right intention. I think the enforcement of the law, good enforcement of the law is equally important. And we really have to legislate the shadow banking world, because one of the reasons why the shadow banking world has developed is precisely to get around some of the important leverage and capital regulations. So I would say two things. Any leverage regulation that does not address the shadow banking world will simply push more leverage into the shadow banking world. And two, the right way to proceed is to legislate transparency so that regulators on a high-frequency basis can actually observe the leverage of these institutions and provide timely, aggregated reports to themselves as well as to market participants.
Thank you, sir. Professor Walker, you say in your testimony, I believe, quote, I believe that the TARP commitment was essential, end quote, and later say, quote, our economy would be rebounding much more slowly than it has if we had not implemented the TARP program, end quote. Of course, a lot of Americans were very upset about TARP, and most of us who voted for it didn't feel good about it when we did it, but we felt we had to. And all the experts that looked at this said we didn't have an option. Will you elaborate, sir, on how, if TARP was not enacted into law, the situation might have been worse, not just for Wall Street, but for Americans and our constituents back home, if you agree with that?
Yes, I do, Congressman. And I think that without TARP, we could easily have had unemployment double the current rates. There have been a few policy pieces written on that, and maybe not as analytical as we would all like. But I think there was a real risk. The other thing was that, and this was sort of my perspective at the time, was that it was clear that Congress was standing up and tackling this vigorously, And I think that inspired some confidence. I think it may have inspired some confidence in international markets. Yes, we had this crisis, but we weren't going to ignore it, and that the Congress was taking the lead.
Thank you, sir. My time has expired. Ms. Biggert, you're recognized for 5 minutes.
Thank you, Mr. Chairman. In the Wall Street Journal today, there's it says a Fannie Mae political reckoning article, and I just want to read something from there. It says the Financial Crisis Inquiry Commission spent yesterday focusing on financial leverage, using Bear Stearns as an example. But Fannie and Freddie were twice as leveraged as Bear and much larger as a share of the mortgage market. Fannie and Freddie owned or guaranteed $5 trillion in mortgages and mortgage-backed securities when they collapsed in September 2008. Reforming the financial system without fixing Fannie and Freddie is like declaring a war on terror and ignoring Al-Qaeda. And then with the former panel, I asked the other Mr. Walker about that there were some alarming numbers regarding the federal debt, especially when you account for the debt owed to Social Security, Medicare, and the total GSE liabilities. What should be done regarding GSE debt? Can the federal government afford to continue writing a blank check to Fannie and Freddie? Who would like to start to answer that? Mr. Geanakoplos, sorry.
All right, Geanakoplos.
Geanakoplos.
Means Johnson in Greek. But
Oh, good. It must be Swedish then. Just kidding.
well, we should never have allowed Fannie and Freddie to get so big and so leveraged. The only reason they were able to get so big is the government implicitly guaranteed their debt. So they would borrow tremendous amounts of money, and investors wouldn't think twice about it when giving them money because they figured the money was good because the government was backing it. And many people called for regulation of Fannie and Freddie and called for them for their debt levels to be held lower and called for them to be smaller. And we ignored those calls, and then, in fact, they did fail, and we are now put in the position of having to honor what was only an implicit guarantee. So we could at one point have, at that point, we could have defaulted on the debt. And a lot of it is held by China, a lot of it's held by American investors. We made a choice not to default, and now we hold the debt. And as you said, if you put together Fannie and Freddie's portfolios together with all the loans they insured and so on, it comes, plus if you put together the other government purchases like through FHA, you're talking about $6 to $8 trillion worth of mortgages that our government, debt offset by mortgages that our government owes. And the fact is, there are going to be a lot of defaults. We might lose almost $1 trillion. There are estimates at $400 billion. It might come to almost $1 trillion. I don't know what we can do about it now. We've committed ourselves to back it. Unless we default on it, we're going to lose that money. We just have to prevent ourselves from ever getting in that position again.
Well, would you agree then that the government has to get out of the business of financing or providing guarantees across the entire economy?
The government can never be on the hook for such a tremendous amount of money. Right now, almost all the mortgage lending is being done by the government. There are hardly any other loans being done by the private sector. The government has to find a plan of the FHA plan is to loan at 3% down now. That's again, that outcompetes any private lender. So instead of encouraging private lending, they're discouraging private lending. So I think that we need a different kind of initiative that will foster more private lending instead of government lending.
Thank you. Then, Mr. Walker, given the data that you provided on government debt, which is alarming, would you agree that the government has to get out of the business of financing or providing guarantees across the entire economy?
I don't think we can have the U.S. government get out of that activity, but I think what we really need to do is to make sure that the public understands and the markets understand the various aspects of the debt. I am guessing if we did a survey, and let's say we took just a survey just of people who have business education degrees, undergraduate and masters, just that limited group, and we asked them about the role of Fannie and Freddie in terms of U.S. government, that most would say they are government agencies. We have a tremendous job to do in terms of financial literacy in the United States, and it's not just people who have had no training in terms of understanding risk and leverage and things that this committee is dealing with in these hearings.
So you would call for greater transparency?
Absolutely.
What about, well, we really have, what, two choices. One is that we would put them on budget as a government agency and be under the controls of salaries and everything else, or we would just turn them into a private company and they would fend for themselves, which...
Either one of those would be a big improvement from the current environment, I would put it on budget as soon as possible, and then think about gradually privatizing. I've done a little bit of work in some of Central and European countries in terms of privatization, and actually have a paper linking privatization and fiscal deficits. And it turns out that for the most part, rising privatization needs to accompany larger fiscal deficits. So I'm not sure that would be translatable to industrialized countries, but it is something to be alerted to.
Right. Thank you. My time has expired.
Mr. Lee, you're recognized for 5 minutes, sir, if you have questions.
Thank you very much. And apologize for my lateness, but I'm glad to have a chance to hear from some of you. And it's ironic we're talking about deleveraging of the banking institutions, but one of my bigger concerns is the deleveraging of the U.S. government. And among the lessons that we learned from the financial crisis and was certainly the dangers of financial concentrations. Many institutions were relying on particular investors to roll over the loans, and when those investors would not oblige over the concerns of the leverage of the institutions, as we all know, failures began to result. These institutions were not able to finance through other investors and began defaulting on their own obligations. When I see the administration implementing a policy of borrow and spend, I believe there are very scary parallels to this situation. My background prior to coming here last year was running a manufacturing business, and I know a little bit about leveraging and being able to read a balance sheet. And if you look at our balance sheet, it's a frightening set of circumstances. Under the President's current budget, we are on plan to borrow 42 cents for every dollar we spend in this country. It is... if this was done in the private sector, I'd hate to tell you, the company would be out of business. In just 2 years from now, our national debt will be bigger than the size of our entire U.S. economy. We're talking about close to $15 trillion deficit. Our debt to GDP ratio will be at over 100%. And what people forget is Greece is at 125%. We're not far behind. Now getting to my point here, the Chinese hold a huge amount of our government debt, I believe in total, in aggregate of roughly 7%. My concern is when they decide to stop financing our spending, what ultimately could happen is the same thing that we're seeing in some of our financial institutions. The United States is going to have to search out for other investors. Ultimately, what we will see are higher interest rates, and when you're looking at a deficit of this high, the interest payment alone will typically exceed what we're paying out, for example, in Social Security or tying what we're doing with our with our defense. We have a policy here that the administration is really, in my opinion, shying away from, and we've got to get our fiscal house in order. Maybe I can start with Mr. Walker. Your concerns. Do you agree that this is a real possibility with how leveraged the U.S. Government is?
Everything I know about the numbers that you've posed are very accurate. I was surprised to hear you say the 7%. I thought the number was larger than that, but may depend on calculations for China. I am very concerned about the rise in interest rates, and I cite in my testimony, in the submitted testimony, work of the budget director previously writing about fiscal deficits causing rising interest rates. So I agree with you, but I don't think we had a choice.
If you were an auditor on safety and soundness and you were auditing our books, would you shut us down?
No, I wouldn't shut us down. I would say, as the Comptroller General, former Comptroller General David Walker has written extensively, that we need to make some dramatic changes. I mean, one of the things I've heard him say in other presentations was that we need to index the age at which people collect Social Security. When we started Social Security originally, we said people can collect at age 65, and the expectation was that you'd live 7 years, maybe 9 years. Now the expectation is you begin collecting Social Security age 65, and you could well be collecting it for 25 years. So I think you know, if I were the auditor, I don't have that training in accounting, but I would say, look, we need to go back and make a lot of changes in how we're committing.
Does anybody else want to comment in?
Yeah, I just wanted to echo something that President Hoenig actually mentioned earlier in the day, which is that I think the real danger we face is that the pattern of capital flows, so in this case, money coming from China, is such that it remains very stable for long periods of time, and boom, one day it will just start reversing itself.
If that were to occur, what impact would you expect to have happen?
My sense is that it's kind of too late to do much at that point. I think
if China stopped buying our debt, what would you think the short-term impact would be?
I think the short-term impact would be a substantial rise in the borrowing costs compared to what we have. There's a sense in which I think the flood of Chinese money coming in is a mixed blessing, which is that it's sort of masking actually the
it's much like the housing market. When we had the bubble, nobody wanted to end the parade, and now we've got China coming in, buying our debt, and again, it's giving us an excuse not to make some hard decisions in this country.
Absolutely.
With that, I appreciate your comments, and I'll yield back.
Thank you, sir. We're going to do a second round of questions, if that's all right. Professor Geanakoplos, you make some suggestions that instead of monitoring leverage on a firm-by-firm basis, especially if those firms have an incentive to use off-balance sheet instruments to hide their true leverage and risk-taking, that we should monitor leverage on a transaction-by-transaction basis, looking at how much down payment was used to purchase a security. Would you please, sir, explain how this might help us better constrain excessive leverage?
Thank you for the question. You've put it exactly the way I intended it. Everybody who borrows money practically has to put up collateral. So if you monitor things transaction by transaction, you get all the transactions. So you'll find out not just about a few banks how leveraged they are, you'll find out something about the entire system. That's number one. Number two, the transaction, I call it security leverage, the down payment is an accurate indicator of where the economy's going. If you do investor leverage, you often get the opposite number. So take a problem where, like we had recently, the market's going down, nobody's able to borrow precisely because they have to put up too much collateral. So the actual leverage is going down in the system. But if you look at one of our big banks, their leverage is going up, most of those institutions, because they're, Lehman or Bear Stearns, just before they go out of business, they're running out of equity, and it looks like their leverage is skyrocketing. So if you measure investor leverage, you're often going to get precisely the wrong number. So just at the moment when there's a crisis, and if anything, you should be loosening leverage, their leverage looks like it's getting tighter, and the regulator might be led to do the exact wrong thing. So thirdly, as you said, you can hide your leverage if you're an institution. You put things off balance sheet, you do all kinds of tricks. But if you're talking about an actual transaction, the lender is going to want protection. So there's going to be real collateral there, and you'll know how much it is. You also have two people telling you what the leverage is. So for all those reasons, and then lastly, if you try to set a 15% rule, I think this could be quite dangerous. You set a 15% rule for a select few institutions, the leverage will move. You'll have a huge incentive to move the leverage somewhere else, and you'll never be able to catch up to it. But if you're looking at it, security by security, it's got to be there. It's something measurable. So I think everyone would agree that transparency is tremendously important. The numbers that should be published every month are averages of the security leverage numbers. So the average down payment on a house, the average down payment on a mortgage security if you buy it. And those numbers, if they appeared in newspapers and generally speaking, people would have a much more accurate picture of what was going on in the economy, and the regulator would have pressure from the public, actually, to do the right thing, because everybody would know where we are. But if you just measure a few institutions, that leverage is going up and down in the wrong direction part of the time, depending on their profitability and not on what the borrowing conditions really are.
Thank you. Anybody else have a comment on this?
I would like
Ms. Williams?
to comment on this. The Systemic Risk Council concept right now continues to be very much individual institution focused, but if the council is really to function effectively, it needs to be able to look for risks throughout the system. And this offers an interesting way to begin to try to peel that onion of looking at and identifying risks that may be building up in the system that poses a systemic risk. So I think it's an interesting idea.
Mr. Acharya?
I would just like to add one institution that is being discussed which could serve a very big role here, which is the Office of Financial Research, which is being discussed. And I think its goal should be exactly, what John has described, which is to record the financial transactions which are taking place, be it issuing a new debt out there, it be doing a derivatives transaction. And the most important thing is that some of this information is being recorded right now, but no one is actually recording how much upfront payment or collateral is actually being put up when the transaction is being done. Even in our derivative contract records, we don't have this information right now. So we are relying on markets' ability to discipline each other, but I think that's leaving a lot to the market.
Could I add one more thought on that? I just
Yes,
want to
sir.
reemphasize
Yes, sir.
that point. So one of the ways of leveraging the system is using derivatives. But this, and people say it's very hard how to keep track of leverage when there are all these derivatives and things. But actually this transaction by transaction approach works there too, because if you write a CDS insurance contract saying you'll pay if the bond defaults, you have to put up collateral for that too. So we know how much collateral is being put up for that as well. So you'll cover the derivatives case as well as leverage moving around, and it's a principled way of getting at the problem.
Thank you. My time has expired. Ms. Bigger, do you have questions?
Thank you, Mr. Chairman. Ms. Williams, thank you for talking about the risk as such. I hope that you'd take a look at 3310, which is the Republican bill, which really addresses that issue. In your study of leverage, did the GAO review the current status of the balance sheets of the GSEs, Fannie and Freddie?
We did not include them.
Can you do that, or is it? I mean, can you do it?
Yes.
Yes. Well, since Fannie and Freddie were leveraged twice as much as Bear Stearns, does the GAO plan to examine why the GSEs were leveraged to such extremes?
We currently don't have plans and we haven't been asked to do that, but if we were asked to do that, we would.
Okay, is that because it's off, well, there's no reason, it's just you haven't been asked?
Correct.
Okay. Would this fall within the mandate to examine leverage in ESA?
It's something that we could have expanded the scope to do, but on this particular mandate, we were given a fairly short window to do the work, so we did not specifically include Freddie and Fannie in our study at the time.
Could I ask you to do that?
Yes.
Well, I ask you.
Okay.
Thank you.
All right.
Professor Walker, you mentioned that larger institutions are riskier than smaller institutions based on a non-deposit liability to Tier 1 capital ratio. Is that higher level of risk due to the too big to fail status, or is there another issue there?
I didn't do calculations that I guess would direct me immediately to too big to fail. And I think that when we go through and look at individual institutions of the large ones, we see some that where this would surely be a problem and others not. So I think we'd have to take it one at a time. The ratio that I used struck me as a way of getting at the pieces of the leverage and liabilities of institutions that were not deposits, and I'm not assuming all those deposits are insured, but they are different from the other aspects of the liabilities, and I wanted to get a handle on that. I should also mention, and there's a table in my testimony showing this, that I broke large and small at $1 billion in assets. And with more time, I would take that apart and do considerably finer lines to try to narrow down sort of where the break point would be. I'm guessing that it would be 10 billion or maybe even 25, where you would see the higher risk.
With that, I yield back.
Thank you, Ms. Biggert, and thank you to our witnesses. I want to thank all of you witnesses for your testimony today. Today's hearing was helpful to further explore these important issues of debt and leverage, giving us a better sense of how we need to use them for responsible purposes and not get carried away, putting our financial system and economy at risk. At future hearings in this series this summer, we'll be exploring the importance of risk management, better understanding short-term markets like the repo market, financial literacy, and other key issues. I'll ask unanimous consent that the following items be entered into the record: the McKinsey Global Institute's report on debt and deleveraging, GAO and CRS reports on leverage, a paper on growth and debt by Professors Reinhardt and Rogoff, a paper on liquidity and leverage by Adrian and Shin. The chair notes that some members may have additional questions for our witnesses which they may wish to submit in writing. Without objection, the hearing record will remain open for 30 days for members to submit written questions to our witnesses and to place their responses in the record. This hearing is adjourned, and again, I thank our witnesses for appearing and testifying today.